What if the money you think is sitting safely in a bank is actually working every day, just not for you? In this video, I'll explain how banks use your money to make more money in the simplest way possible. No confusing terms, no financial advice, just education to help you understand how the system really works. When you deposit money into a bank, it feels like storage, like placing something in a vault and locking the door. The balance appears on your screen, accessible whenever you want. That visibility creates the impression that the money is idle. But in reality, banks are not storage businesses. They are flow businesses. Your deposit is not treated as something to be held still. It becomes part of a much larger moving pool designed to circulate continuously. Banks are built around one core principle. Money should not sit unused. When money moves, it creates opportunity. When it stays still, it creates cost. Infrastructure, security, compliance, and operations all require movement to remain profitable. So when money enters the system, it is immediately categorized, not as yours, but as available liquidity. Liquidity is what allows banks to operate, lend, invest, and stabilize their balance sheets. The moment your money enters, it gains a role. From a system perspective, your deposit represents trust and predictability. Banks don't need to know what you plan to do with your money. They only need to estimate how long it's likely to remain. This estimation is crucial. Most people don't withdraw all their money at once. Withdrawals are staggered, predictable, and spread over time. That predictability allows banks to confidently put money to work elsewhere while still meeting daily withdrawal needs. The system isn't guessing, it's modeling behavior. Banks don't take your exact money and hand it to someone else. They use your deposit as a base to support larger activity. Through structured rules and safeguards, a portion of deposited money is kept available while the rest supports lending and investments. This creates a layered effect where the same base enables multiple actions over time. Nothing illegal, nothing secret, just design. Your balance remains visible to you, while the system extracts value from its presence. The reason this process feels invisible is because it doesn't interrupt access. You can withdraw, transfer, or spend your money whenever needed. As long as access remains smooth, there's no reason to question what's happening behind the scenes. Convenience becomes camouflage. Banks benefit because they earn returns on money that largely stays put. The system benefits because liquidity keeps economic activity flowing. And depositors, they receive stability and access, not participation in the upside. This isn't a moral judgment, it's a structural observation. Once you see deposits as fuel rather than storage, the relationship between banks and money looks very different. Your money isn't idle, it's active, just operating on rules you're rarely shown. The issue isn't that banks use deposited money. The issue is that most people misunderstand what role they're playing in that system. That misunderstanding leads to expectations that don't match reality. Many people treat banks like digital lockers. Money goes in, stays untouched, and comes out when needed. Because access is instant and balances are visible, it feels logical to assume the money is simply there. But visibility is not the same as inactivity. This assumption creates a blind spot. When people believe their money is resting, they don't question how its presence is being leveraged elsewhere. The system doesn't correct this belief, it benefits from it. Another common frustration quietly builds over time. People notice that the return they receive on deposits feels small compared to how much banks appear to earn. This isn't because banks are hiding profits, it's because depositors and institutions are playing different roles. Depositors provide stability and liquidity. Banks convert that stability into activity. Expecting both sides to receive similar outcomes misunderstands the design. Easy access creates the illusion of control. If you can move your money at any moment, it feels like nothing else is happening. But control and utilization are not opposites. A system can give you access while still using your presence as support for other operations. This duality is where confusion grows. People assume, if I can use it, they must not be using it. The system operates on a different logic. Most deposit behavior is long-term by default. Balances remain in accounts for months or years, with only partial movement. People don't think of this as time exposure because nothing feels locked. But from a system perspective, predictable duration is valuable. Time, not ownership, is what makes deposits useful. And time is often underestimated. Every system involves trade-offs. In banking, the trade-off is simple: stability and convenience in exchange for allowing your money to be used. Because the exchange isn't explicit, it doesn't feel like a decision. There's no moment where someone agrees to the terms consciously. The system moves forward by default. Over time, people accept low returns as normal. They stop comparing their role to the system's role. What once felt questionable becomes standard. This normalization is powerful. Once expectations adjust downward, the structure goes unchallenged. Not because it's unfair, but because it's understood incorrectly. Banks don't take advantage of deposits. They depend on how deposits are perceived. When money is seen as storage instead of fuel, the system continues smoothly and silently. Once it's clear that banks don't treat deposits as storage, the focus shifts away from fairness and toward understanding roles. The question becomes simpler and more useful. How does the system think, and where do individuals fit inside it? Banks don't think in terms of ownership. They think in terms of flows, timing, and reliability. What matters most is not who owns the money, but how predictably it behaves once it enters the system. Predictable money is usable money. If deposits arrive consistently, remain stable, and leave gradually, they become a dependable foundation. From that foundation, the system can safely expand activity. This is why behavior matters more than balances. A large deposit that moves unpredictably is less useful than a smaller deposit that behaves consistently. Smart system thinkers recognize this distinction. They understand that banks are not impressed by amounts alone. They respond to patterns. Duration, regularity, and continuity are the real signals. Money that stays visible and calm over time is far more powerful to a system than money that appears briefly and disappears. Depositors usually optimize for safety and access. Banks optimize for leverage and scalability. These goals are not in conflict, but they are not aligned either. Problems arise when depositors expect the system to reward them as if they were participating in the same game. They are not. Banks operate on aggregated behavior across millions of users. Individuals experience the system personally, but the system responds statistically. Understanding this gap removes a lot of frustration. Individuals experience time emotionally. A month feels long, a year feels significant. Institutions experience time structurally. Years are data points, decades are normal. When money is placed into a system that thinks in decades, but expectations are formed in months, disappointment is almost inevitable. Smart thinkers adjust expectations, not by demanding more, but by understanding the mismatch. Arguing with a system assumes it can be persuaded. It can't. Smart users don't expect banks to behave differently out of goodwill. They expect them to behave exactly as designed. Once design is understood, decisions become less emotional and more contextual, not reactive, but informed. This shift alone changes how money decisions feel. One of the most powerful mental shifts is moving away from ownership-based thinking. Instead of focusing on "this is my money," the focus becomes, how does this money behave once it enters a system? That single question explains more outcomes than most advice ever will. When the relationship between banks and deposits is seen clearly, it stops feeling mysterious. Not because the system changes, but because expectations finally match how it actually works. When you step back and look at the full picture, the relationship between banks and your money becomes much clearer. Not emotional, not personal, structural. Once you understand that banks use money based on behavior and predictability, expectations shift. Banks are no longer seen as passive holders of money. They are seen as managers of flows. This doesn't make them villains or heroes. It simply defines their role. And when roles are clear, confusion disappears. Legally and practically, money in a bank account feels personal, but functionally, it becomes part of a shared system. The system guarantees access, not isolation. That distinction explains why banks can generate returns using deposits while still allowing withdrawals. The design assumes not everyone will need everything at the same time. This assumption isn't risky behavior, it's statistical reality. Many people believe control comes from possession, from knowing where their money is. In reality, control comes from understanding how money behaves once it enters a system. When you understand the rules, outcomes stop feeling surprising. You may not influence the system directly, but you can stop misinterpreting it, and that alone reduces frustration. Banks operate on scale. Individual deposits matter less than collective patterns. This is why personal loyalty or intention doesn't change outcomes. The system responds to aggregates, averages, and probabilities. Expecting personalized outcomes from a scale-based system leads to disappointment. Understanding scale restores clarity. Once the system is understood, questions shift. Instead of asking, "Why do banks make so much from my money?" the question becomes, "What role does my money play in a system built on scale and time?" That reframing changes how money decisions feel. Calmer, more grounded, less emotional. Banks don't use your money secretly. They use it systematically. And systems don't hide. They simply operate according to rules most people never stop to examine. When those rules are understood, money stops feeling like something that's happening to you and starts looking like something happening around you. This content is for educational purposes only. It is not financial advice. If this helped you understand how banks really use money, consider subscribing for more educational breakdowns like this.